So, all right, everyone. Thank you for coming here. Again, my name is Chris Haven with Personafi, and this is our community class. We're going to talk about spreads, and we have let me correct you. We're just talking about a debit spread. There are four of them when we talk about spreads, but I just wanted to do just one, just focus on one to get the concept, and then we'll explore the others with our guest, which is Jeff. So if Jeff, you want to say hi.
Hey everybody, good evening.
So I'm trying to figure out, because I'm recording the screen, if I should have you. I don't know how I'll do that. We'll figure it out.
I see a share screen at the bottom, so once you get
Okay.
done to that
Okay.
point, I'll just snag it from you.
Perfect. So, anyways, before we start with this, I just want to let everyone know with these options, because you're dealing with options with this, and I mean, it's not highly recommended. It is needs to be. You need to have at least listened to the podcasts earlier on options, or attended the classes for these, or have a clear understanding of what options are, because we're dealing with a combination of options of buying and selling at the same time. And what can happen is, if you place the wrong orders, meaning if you maybe, for example, bought two of them instead of just buy one, sell one, you're going to now be in a lot of trouble, because it's not what the actual strategy is. And also, you do need options approval level 2 or 3. I say 2 or 3 because some brokers have options levels 1 through 4, others do 0 through 3. I know E-Trade is 1 through 4. Mainly everything else is 1 through 3. But I'm just telling you on that because you're going to be entering more complex positions. I know a lot of people use Robinhood. I'll have to turn to my expert Jeff on that. Can you do spreads on Robinhood?
I think it's level 2 that you can start
Level
doing
2?
spreads. Yep.
Okay. So with that, you have to refer to your broker on all that, and then do the necessary paperwork if need be, and the suitability requirements. So there's not much for me to really explain, because it's just talking about a strategy with options rather than a whole new investment product. So we talked about stocks before, buying and selling. We talked about options, which is now we're diving deeper into the options, and then we're going to explain. So this is a strategy that's used, that a lot of people use. So what I'm talking about is going to be what's called a debit spread. And I know some people will say, okay, this, it may not be this, but on your broker, a lot of the brokers, they will categorize them as a vertical call. So that's what we're going to focus on. There's a lot of different strategies, but I'm just going to show you what the main premise of a spread is, and then how you can use that. So just so you know, and I'll list them all for you in case you wanted to explore them. When we talk about spreads, we're going to be looking at, give me 1 second, you'll look at what's called a vertical call or put. We'll talk about a calendar call or put, or a diagonal call. Diagonal call or put. Okay. And there are others that are called, they would be called combinations, or ratios. We're not going to talk about those, but the main thing that we're going to talk about is going to be, let me circle it for you, is going to be this vertical call, because a vertical call is still considered a debit spread. So when we talk about spreads, this is kind of like the main category. When I look at vertical call, that would be considered a subcategory of it, kind of like, I'm not even going to the math stuff, but so that's what you want to look at or look for on your broker if you're talking about a for a debit spread. And then Jeff will go more into different time lengths and going into all that with that. So what this actually is it's buying and then selling an option I put different strike prices. The true definition is a similar one, but to offset the purchase of a single option or anticipate only a slight upwards movement in a stock. Oh my gosh, what does this mean, Chris? What does this mean? So with both options and stocks, you can both buy and sell something. Okay, now you've heard of the hedge funds talking about shorting. When we talk about selling something or selling something to open it, we are actually shorting a position. So let's see. So we're actually, so the strategy of this is to actually short, both go short and long an option at the same time. Hold on a second, guys. I'm just doing a couple things. Okay. So what the initial goal is let's say you're looking at, and I'm taking AMC, for example. You think AMC is going to go up, but you're not quite sure how high it can go. And you want to make sure like, hey, well, what if it reverses on X, or what if it reverses and I have no idea? This is kind of a way to put your some money in the game, but not putting as much as you needed to. And then you have some protection with that. So let me just kind of show you what I mean. So I'm using, so this is, hold on one second. Oops. So let's look at, for example, AMC, since we're talking about AMC, everything's about AMC right now. So if I'm looking at AMC, and this was before earnings was, yeah, when was earnings for AMC? It was sometime this week, right? Yeah.
It's Monday or Tuesday? Monday.
Monday or Tuesday. So let's say you did an earnings play and you're like, okay, I think AMC is going to go upwards, which it did. And let me erase a lot of this stuff. Hold on a second, guys. Sorry about that. Yes, I want to remove. You want to do an earnings play on AMC, but let's just say you looked at the prices and you're like, oh my gosh, I don't want to pay all that. Or you're just any other stock and you're like, oh, I mean, I don't want to pay all that money. So what you could do is you can do what's called a debit spread. So a debit spread is a bullish move. And what that means is you're expecting the stock to go up. So if you think the stock's going to go up, you're going to buy a call. But you're like, oh, I don't want to spend $200. I would rather spend $100. But the call is $200. So what you do is you both write and sell a position. So that means you both buy a call and then short a call at the same time to get a credit, which then gives you additional leverage with the stock to go upwards. Okay, so what happens is this. So I'm going to draw on the chart. Okay, so if you can see, and I'm just going to take the earnings play for AMC for the example. Okay, let's say it was Monday morning and you're like, okay, AMC to the moon, you know, come on, Elon, talk about Doge, have AMC involved, you know, do something, get us something involved. And so what you'll do is you'll say, okay, well, where's AMC at? So AMC opened right here, which is roughly 32.50. And let's say you're super bullish on AMC. So you're like, I'm going to buy a call for AMC at 35. So this would be the position right here. And it's funny how I said 35, just must be a gift of mine or something of where I'm seeing things. But let's do, we're going to say 35. Okay. So if I were to look at AMC, take this, hold on a second.
Where's your phone?
So this is August 13th. So we're just use the same prices that we see. So I'm going to buy an AMC call, and I know it's kind of hard to see. Sorry. It's hard to see, but roughly the bid's 31 and the ask is 32. So let's say, okay, I want to buy a ton of calls on AMC, but I really don't want to spend the money because I'm not 100% sure. So what you do is you pick another call within a reasonable price range. So let's say to 40. So I'm going to write that down. Hold on. Let me make a new slide. So I want to buy AMC call for 35 for August 13th, 2021. I don't have enough tendies from the bad plays. I already did. So I am going to buy AMC call for 35 and then sell AMC 40 call. Now, you can choose the price. It just has to be greater than the entry price. Okay. So when I mean entry, you pick a call that you want. You can do a call below what it's at. So like if you want to do a spread, a debit spread of 29, because it's at what? What's it at right now? 32. You can do whatever you want. That's fine. Just be very careful with that because stuff can, you want to generally look at something around there, but then give yourself some leeway. And I'm going to show you on a graph what that kind of looks like. Okay. So I chose 40. The reason why I chose 40 is because I see it at $11 and then $12. But I see there's a $5 price difference. And how I did that was I looked at kind of the price of, let me go to here. I looked at kind of the range of where AMC has been trading. For the longest time, it hit 38. So if I think AMC is going to 35, which it could, I mean, it's been up there. It's tested around 35 a couple of times, then hit support there, but then went back down. But I chose something that's further out. Remember, with options, OTM is out the money. So you usually choose one that's out the money that may not be obtainable. It could be, but may not be. And so what that does is this. So if I chose 35 and 40, oops, give me one moment. So let me actually capture that picture. So the price for AMC 35 is, and remember you're gonna go for the ask price. So that would be $12. Oops, sorry. $32. Oops. And then simultaneously, so you're going to put in one order. You're going to sell to open. So I don't know if you guys had me last year, but I told you never do sell to open, never do buy to close. Well, guess what? It's changed now. I've released the opportunity for you to do those, given you're able to do it. Okay. So you will also sell to open the AMC 40. And remember, if you're going to buy it, if you're going to sell it, when you sell to open, it goes to the bid price. And the reason why is because you're buying, someone is willing to sell it to you, but it's cheaper because you're doing a reverse position. Okay. These spreads are so minuscule, you don't really need to worry about the money wise, but when you get larger spreads, that will play a role. Okay. Now, for you accounting majors, hold on, let me let my doggy out because he's scratching. Remember debits and credits. If you have a debit card, that's money that you own in your checking account, and a credit card is money you don't have. So when a company credits you something, that means they're giving you money. So when you sell to open, when you sell to open, that means they are crediting you, or that means you're selling it to someone else. And so they're crediting you, they're giving you $11, but you have to pay 12. So again, not everyone is an accounting major or has an MBA or whatnot, but if you look at this chart, if I put D for debit, C for credit, you're credited $11, but you have to debit 32. So really what you're doing is you're buying those AMC calls. You're given 11, you have to pay 32. So someone gave you $11, you're spending $32. So 32 minus 11 is $21. So you essentially bought that call for $21. However, there's a caveat to it. Because now you sold something, you are now limited to how much money you can gain. Because remember, if you have a call option, if AMC were to hit $1 million, well, guess what? No Lambo for you this time, unfortunately. Because these will also move in tangent with each other until they expire. Because remember, if options expire worthless, it's worth nothing. So if you were to have sold something, sold to open or sell to open, you were credited $11 and the option is worthless, you keep all that money. That's what a lot of investors do if they own calls. I'm sorry, if they own stocks. This is similar to a covered call, but it's not, because you're buying two options. Before I move on, because I know it's a little bit more of an advanced topic, are there any questions just on how I picked the AMC and then how I essentially paid $21 for this, not the 32 in its own? And again, you can unmute yourself. I muted everyone because there were some people talking. So if you have any questions, you can type in chat, you can ask, you can unmute. You're more than welcome, whatever it needs to be. So Josh and Jessica asked, do you always sell higher than the buy price? Yes. So this is a debit spread. Now, the reason why it's called a debit spread is because you have to pay money. Whereas if you were to reverse that, so if you sold at a lower price, oh wait, no, that would make sense. Sorry, I'm getting ahead of myself. Okay, let's just keep it. Let's just keep this topic. So yes, you do. And this is only for bull, meaning you want the price to go upwards.
Yeah, Josh and Jessica, this is Jeff. I have a nice little chart in my slides to show you guys. So
yeah. So again, I'm just going over the concept. Jeff's going to go over more of the finer, minute details. So what happens with this is, think of a force field. So I'm going to draw a really crappy chart, and you'll see what happens. So let's just say this is the stock of AMC. I bought a call here, bought a short here, and don't worry, I'm going to create this thing. I wanted to create it. So short 40, long 35. Okay, so this is what happens when, so this is what happens to the price. Give me one moment, going to a different color. So obviously, if someone were to short an AMC call at 40, you want the price to go downwards, but you're also long 35. So what happens is these calls, so if the price of, if the price of AMC goes upwards, this stock, I'm sorry, this call goes upwards, but the cost of this goes upwards too. However, this moves slightly higher on how fast this goes. And the reason why is, if you remember the theta and the delta, so remember delta is the rate of change of the call option. So essentially what happens, oops, my internet connection is unstable. That's nice. So essentially what happens is this intersects at a specific break, or I'm sorry, at a specific point. to where that's the maximum amount of money you can get. And the maximum amount, you would get for that would be, I don't even know.
500.
Is it 500? Yeah, the max gain would be 480. However, your max loss is 20 bucks. So that's kind of how it works with that part. The goal for this is you want the price to go upwards, but then when it reaches a certain price, then you just close out of it and then start a new thing. Now, don't let these debit spreads fool you and think, oh, I'm only risking $20, but I can make $500, because you have to think, again, if you remember all the previous stuff, realistic expectations. If AMC doesn't hit 35, you're going to lose your money. If AMC hits 40, you're in a lot of money. Now, could that happen? Yes, it could. With this amount of pricing, would it be reasonable to maybe do AMC for this type of spread? Honestly, I mean, if it's $10 difference, I wouldn't. I don't know people's finances, but but if you're doing something like Amazon calls, those are hundreds, if not thousands of dollars, and you can put more money, you can put more skin in the game for those bigger guys, those bigger companies. Any questions before we move on? I didn't go into the math on purpose because I just wanted you to see visually, it's just basically an intersection of a graph. Now, over time, each day, the theta decay does occur. So when you're doing like a weeklies with this, you could lose the money unless AMC does pass those prices. No questions? Okay, so then again, just a couple things to remember. This is kind of what I did. Just to summarize, so when you deal with a debit spread for a call debit spread, that is a bull move, meaning you want the stock to go upwards. And then you would choose one lower call, and then you would go long on that. So you would buy it, then you sell to open or short a higher expiration price. Again, just look, if you're trying to pin this correctly, look for reasonable target prices. So what reasonable means to you, I can't tell you. That's whatever you want to think. But look at reasonable to then maybe gauge on what can go in and make a profit. How'd I do, Jeff? Okay?
Yeah, you did really good, man. Thank you for that.
Yeah. So I'm going to make Jeff the host.
All right.
And just so you guys know, I have to tell you, this is my last community class.
Really?
Really.
Man,
yeah,
you've been recording all of these. I understand it though. It's a new gig.
So this was my swan song, if you guys know what that means. But I just wanted to say thank you. And we'll still have classes. I'm not sure how it's going to go, but we will. They'll still continue. Just I don't know how. We haven't figured that out yet. So, anyways, this is Jeff. He's going to go more into the technical aspect of how to determine what to do, and then also kind of look more into other opportunities with that. So,
there you go.
And again, I'll still be sticking around here. So if you have any questions, I'll be monitoring the chat, and I'm going to mute myself. And all right.
Well, I might ask you some questions too, Chris, if
Yeah,
this is your last class. So.
Yeah, it's last class, unfortunately. But I'm always around. So if you ever need to find me or message me, I'm just busy. Sorry.
Gotcha. No, I understand, man. Can everyone see my screen? I'm assuming yes. All right. So, hey, everybody. My name is Jeff Bonneville, and I'm going to be covering debit spreads this time. I just want to give it just go, I guess, a slow start because originally I was going to cover both debit and credit spreads, which we had talked about. But oh, my app name is @SpurPickle on the Personafi app. Great question, Chris. So yeah, feel free to once you guys jump in, if you guys want a link or have not already gotten onto the app, it's currently iOS only right now as a beta, but we will be rolling out Android soon. But yeah, feel free to follow me. I'll throw it in the chat so that everybody can just grab it real quick. But so I'm going to cover debit spreads. And then if there's a lot of interest in the future, I can also cover credit spreads, which is basically what I do weekly to build my capital personally. Now, as Chris had mentioned in the beginning, you will need at least level 2 or level 3 options trading unlocked on your specific broker. I think for Robinhood, it's level 2. Webull 3. Tastyworks, which I use personally, is 2. And then there's a bunch of others. I'm not sure about Ameritrade or Thinkorswim. So, but so debit spreads, as Chris had said, the idea is to leverage spreads to protect your capital by reducing the amount of money that you're actually spending on a call. So let me go ahead and go to the next slide here. Ah, Chris, why are you so sad, sir? Don't be sad. Don't be sad. There we go. All right, so debit spreads. They are basically, as Chris had spoken, it's an option strategy where a trader buys an option with debit and sells another option of the same security being the same stock, so AMC or Lulu, at a different strike price for credit, resulting in a reduced amount of debit spent on that amount. You can still be bullish or bearish on whatever stock that you're planning to do this trade on. Just remember to always be goatish. This was actually a saying from my old trade group, so I figured I'd throw it in here. And that just means that don't fall in love with the stock and be ready to ride it up or down, and trust in the technicals. So debit spreads. Why would we do a debit spread instead of an actual just naked call? Naked options, as you know, have you fighting theta or time as well as direction. And then debit spreads will reduce your risk at the trade-off of limiting your gain. However, as the caveat said, as Chris had said, with the delta, even when you're in the money, so when that AMC call had gone through and been in the money, you still have to wait until the IV or the intrinsic value matures, which could leave you exposed to sudden moves in the wrong direction. So use your best judgment. For me, 20 to 50%, if I have 50% value growth, I'm going to close that position. I almost closed it with Lulu, but it was just a little too, I felt like we could get a little more out of it. So I'm going to hold on, and we got plenty of time. So, and then the other caveat for a debit spread is that it limits your gain to the difference between strike prices. I'm hearing binging. I'm not sure if that's a chat message or not. Let me see here. There we go. Okay, no, it wasn't. All right. All right, so yeah, it limits your risk. You limit your gain by spreads. Selling naked options, it exposes you to infinite risk. You never want to do that unless you're a barbarian. Never sell to open. I'm telling you again, I repeat, never sell to open an option, call or put by itself, because you're going to have thousands of dollars to cover it. You hear those horror stories about people on Robinhood when their account goes sideways and they end up owing like $560,000. So don't ever do that. You're always going to sell together, one buy and one sell at the same time, and you're always going to close out before it expires. Don't let it expire. If it expires, it's worthless. Always sell before the expiration date. The nice thing is you get to also choose what level of risk you undertake. So you can do far from the money, like AMC, where he picked a 35, which was pretty far from 32, and it was cheap. It was 21 bucks. I have I think my call for Lulu was $3 off. So at the time, Lulu was $405 a share. I chose to do an in the money buy, which was 405, and sell a 410. And that cost me a little bit more than 21. That was actually $215, but it just depends on what you want to do. I'm going to gain less money from it, but I also have a chance of it staying valuable for me and not losing a lot of money. All right, so there are two basic debit spreads I want to talk to you guys. Chris already covered the vertical debit spread very well. I'm going to go over it again, however, just quickly. And then also there's the calendar spread, which I wanted to cover, also known as a diagonal spread, where it's a little bit different. You would not be selling, it's the same strike price, but time difference. It's interesting. All right, so this is the chart that I think I wanted to show you, Josh and Jessica, for the call debit spread. So this is bullish. This is if you're bullish on the stock. And basically you're buying and selling at the same time. As you can see, the break even price right here in the middle, that would be what the stock price is. So he had done a long call at that first gap right there. Whoops, sorry, I didn't mean to click. On the left side, where the red arrow starts to turn up a little bit. And then he sold a short call where the green turns up. As you can see, your maximum profit line is that short call strike price. You can't make any more profit than that. That's that short call. And that's kind of what is going on with the debit spread. Is there any questions on vertical debit spreads by anyone? Go ahead and unmute yourself and feel free to ask. And I will be showing you an example from my account after this. All right. So we'll go on to calendar spread. Calendar spreads are very interesting. Still kind of takes a little bit of thinking on my part, but where you would do, it's where where a trader would sell a strike price. So you'd sell a call to open. Say, we'll use AMC as an example. We think that, now I wouldn't use AXE as an example. You want to use something that has lower IV, which is volatility. So let's think here, maybe like Q yield or any other kind of dividend stocks, which doesn't move a lot. So let's say Q yields at 20 bucks. We'll sell a call for $21 2 weeks from now. So 2 weeks in the future. But what we'll also do is that we'll buy a call 3 weeks of future, but for the same strike price. And then what you do is at that point is you just sit and wait. Now, Q yield's most likely going to stay at 20 bucks because it doesn't move a lot. Over time, as we get closer to that short call expiring in 2 weeks, you're going to, the theta is going to eat away at the value of that option. Now, as that, but it's going to eat away less at the long one. So the closer sell open is going to deteriorate faster than the long call farther out the buy. And what will happen is, even though you're paying a debit for that, your debit's going to grow because you're going to basically acquire the credit faster than you're going to be spending the debit. It's a really interesting style. I'm actually thinking about doing it in the near future. It would be my virgin calendar spread. So know that I'll be putting my skin in the game on that one for if anyone's interested in following me. So, and here it is. So you're basically selling a call with a near-term expiration, buying a call with a longer term expiration, and then waiting, basically waiting for theta to pass. The downside of this is if the stock moves abruptly over, then you'll end up owing money or losing the amount of debit that you had. So, and then here are a couple sources. I'm going to throw these in the chat for you guys as well. So that way you can grab those. So let me grab these real quick for you guys. And they're in the chat, so you can do a little bit more research. Here's the calendar spread trading. And here's a really cool video from Tasty Trade. So I use Tastyworks as a broker, and they do fantastic educational videos on options. I highly suggest checking them out. They're free on YouTube. Go check out Adam and his whiteboard. They're a really good group, fantastic stuff. And then I'm going to show you my account here with Lulu pulled up. So this is Tastyworks. And if you guys remember, I had sold 2 weeks ago in the newsletter, purchased the 405 call for August 27th, and then I sold the 410 call for August 27th. Now that is a straight up bull vertical spread. I think the stock price was going up at the time. It broke and held 404. I was really happy with it. So on Monday, I picked it up. As you can see, it shot up. It was, I believe, right about here when I purchased it. And it shot all the way up to 415. I almost sold it, but because my dates were so far out, it wasn't valuable enough because, as I said, you have to wait for the intrinsic value to mature before it actually kind of kicks in. Also, if anyone has ever traded Lulu before, the spread is kind of horrible. So I decided to wait. As you can see, it came down a bit, but as of right now, it's still 408.82, which means that my call is in the money. So had I not sold this call, I could potentially, and this call expired at 408.82, I'd make $382. But since I still have 2.5 weeks left, I'm going to wait a bit. I think it can go back over 410. And then once it goes, it should go, I would say, probably around 350-ish value-wise, and I'll probably sell it at that point. As you can see here, I'll show you my activity for Lulu. And I'll show you what I did. All right, so here's the actual purchase order that I did. And as you can see, 215, that's actually $215 because if you know any option cost is times by 100 because you're playing with 100 shares here. And you can see DB, which means I paid debit for that. So I paid $215. So my maximum profit that I can gain from this is 410 minus 405, which would be $500, but also minus my cost, which was 215. So I can make a total of 285, which is pretty decent amount. I'm okay with that. Now, does anyone have any questions about vertical debit spreads? You want me to see, like, pick one up or show you what I would look at maybe?
And just looking at that, so you guys know, if Lulu went the opposite way, if Jeff was just to buy a call, then he would be down a lot of money compared to not as much. However, the downside,
I think originally the call was $440. So I saved, I shaved off almost half of that by doing a spread.
So Josh and Jessica were asking, could you explain the max profit? With the max profit, what you do is you take the range of the calls. So, and I didn't see what yours were.
405
So
and 410.
So it's basically a $5 range. And remember, you're playing with hundreds. So your range is 500. However, you have to subtract your debit amount. So because he bought and sold at the same time, his total out of pocket, so how much he spent, was $215. So the max he could make would be the 500 minus the 215, which is 285.
Yep, that's right.
Yep. And if not, just divide by 100, just do whatever it needs to do.
Yeah.
So
yeah, watch that the video I put into the chat about the debit spread by Adam. He does an incredibly good job of explaining it. Also, there was Options Alpha, I think they also do debit spreads, and they're pretty good too, but I really like Adam and Tasty Trades. So let's see what else we got here. Oh, thanks, Josh. I appreciate that.
Are there any questions on looking at a particular debit spread? I can't say whether or not it may look good, but Jeff can. I can't anymore.
It's basically what I do all the time now. So I'm either doing debit spreads, or honestly, 90% of my time it's credit spreads, but I wanted you guys to get a good handle on what a debit spread is before dipping you into the crazy, crazy world of credit spreads, because there are numerous strategies for that. But also you have to be on your toes and always, always close out, because as I said, you never want to have a short position open when it expires, because someone may pick it up. And I actually recently learned this, maybe about half a year ago, is that expiring it worthless, the person that purchased it still has until Monday open to exercise that option, even if it would lose their money.
11:59. I'm sorry,
Is it
5:30. 5:30 after close. Sorry, not 11.
Oh, okay,
I'm thinking
gotcha. So
yeah,
gotcha.
so they
So
have to
5:30
call the
after close.
broker by 5:30. So, and I
Yeah.
mean that on Eastern time. So after
Eastern
the market
time.
closes.
So they have an hour and a half. So, but still, you can't do anything about it. Like the market's closed, you can't do anything about your spread, your option trades, but they still have an hour and a half of deciding whether or not, well, I mean, I do want this stock and I'm only losing $100, and then it's going to sink you. So just keep that in mind with credit spreads. And if you guys have any interest in the future, seems like there's a ton of risk with this. No, not with debit spreads. It's credit spreads that are the risky ones. I wouldn't say these are as risky. I would just say it's always good. It's being responsible to tell you guys to close out your stock, close out your spread afterwards, before it expires.
So the reason why, Crystal, I didn't go into any other one is this is the most simplistic one, because you're dealing with buying a call and then shorting something higher up. So what's called an assignment risk, meaning where the options clearing corp makes you buy the shares at a certain price. That I did not really talk about, only because I was going to let Jeff go into the more advanced details. So there is risk when doing these. It's just when you're looking at shorting out the money stuff, there's less risk.
Yep. And also it helps you, like, say you've got a small account, say you have under $1,000, putting down for an option, like a lot of the traders have been doing. They've been doing some naked options. It can be $100 or more at times. And not everyone has that kind of change that they can just toss. So by doing a debit spread, that'll basically get you a little bit more bang for your buck, help your dollar stretch a bit. And that's why I've always been interested in them. It helps you be a little bit more conservative with your money. Yeah, that's why I like them. Yes, I would agree, Chris. Is there any more questions?
Jeff, I have a question. This is Matthew.
Hey, Matt.
So I use Robinhood,
Okay.
and is that when you're going to look and do a call, is that when you're adding a stop price to it? So that way you have a limit?
No, it's not a stop price. So do you have level 2 options unlocked for Robinhood?
I do, yeah.
Okay, so you should see, I'm trying to remember. I got rid of Robinhood a long time ago because, I don't know why. I disliked them for a long time. I realized they were doing me dirty. But I'm trying to remember the phone. It should be once you go into a stock price, and then you can click in the upper right corner for, I think it's select. And then you'll see the stocks move, or the options move over, and you can see little check boxes. That will allow you to do a spread. Let me see if I can find something online. Debit spreads, Robinhood. Oh, wow, it's level 3. Apparently,
Okay,
that's
so I'm
what you
only level
need.
2, so okay.
So, okay, here we go. Level 2 allows you to do naked calls and puts. You can sell covered and cash covered puts, and you can do straddles and strangles. So you need level 3 to be able to do it. They must have changed it ever after I left. I haven't used Robinhood in a year or so.
Okay.
But yeah, you'll need that for it looks like credit and debit spreads. So calculations. Blah. So yeah, you'll have to open that up. But basically, whatever I remember from Robinhood was there was a button that allowed you to select multiple options at a time. So you can put as many check marks against as many options as you wanted. But what I would do is I would be like, well, I want a bullish debit spread. So I want a bullish vertical spread on this. So I would hit that select button. I'd check the strike price that I want while it had the call and buy options selected on Robinhood. And then I would change those to, after I checked that box, I would hit sell or sell to open. Yeah, with buy to open, or buy, sell, and open to close with the 2 toggles, I think, at the top. So after you do your buy to open, you would switch that to sell. You scroll up to the next strike that you would want to select, hit that second checkbox, and then it would tell you at the bottom that you're opening up a bull debit spread.
Okay. Thanks.
Yeah. On that, Lulu, what was your credit on your short? So I believe we can actually look at the activity here for Lulu. History. Lulu. Oh, it doesn't go back very far, does it? It looks like it ran out. I believe the credit was about $190 on the credit. So originally that call, I think, was 400 or just at 400 or so. So it would have been $400 that I would have had to pay had I want to buy it naked. And I didn't want to do that. So by doing the spread, I almost shaved the price in half. Any more questions, anyone? I could do another example if you want. Oh, Michael said, would you recommend high volume stocks? I asked this because I'm wondering if you're willing to pay more on your bid price. I would recommend high volume. It's just harder to trade stocks that don't have a lot of options going on, especially when you're trying to sell, buy or sell at the same time. If there's a low volume for the options, if there's low interest, you could actually get screwed pretty easily. So definitely look for something that has higher open interest. I'd always stay, like, if you're ever looking to start, I would stick to the big boys. Apple, Facebook's a good one. I don't know if I'd do Lulu again. Lulu's, as you can see, the bid ask over here is already $1 apart. And by pre-market, this is going to be about $4 difference. So the spread makes it a little bit more, I guess, nerve-wracking when you're dealing with that. No problem, Michael. Any more questions? All right. Well,
All right.
I'll call that a no. And thank you, everyone, for listening to my ramblings and learning a little bit about debit spreads.
Yeah, and thank you again, Jeff. Do appreciate it. So we'll try and get more people on these community classes. And so now when you guys see on the newsletter, when they're talking about spreads, again, some of them may be different. So just be very aware of what is going out there, because it may not be this one in particular, because there's 4 of them, 2 of them being bullish, 2 of them being bearish. But we'll try and get another class coming in that will explain the other components of it and how to tell the difference. So with that, I want to say have a good night, everyone, and happy trading.